Hey everyone! Welcome back to Entrepreneurial Edge. Now I know you're all here to build your wealth and make smart financial decisions. That's why today, we're diving deep into the world of investments, or more specifically, the red flags that scream, run away. We're talking about the 15 telltale signs of a bad investment. Avoiding these pitfalls could save you thousands, even millions in the long run. So grab your notebooks, hit that like button, and let's make sure you never fall prey to a bad investment again. All right, let's kick things off with the most fundamental aspect of any investment, the numbers. Look, I get it. Sometimes you stumble upon an opportunity that sounds incredible. Maybe it's a groundbreaking tech startup or a revolutionary real estate project. But here's the deal. Enthusiasm and gut feelings can only take you so far. You absolutely need to dig into the financials, analyze the projections, and make sure the numbers make sense. If the revenue model is shaky, the expenses are through the roof, or the projected returns seem unrealistic, it's a major red flag. Remember, a great idea doesn't always translate into a great investment. Trust the numbers, not just the hype. This next point is crucial. Never invest in something you don't fully understand. It's like navigating a foreign city without a map. You're bound to get lost. Whether it's a complex financial instrument or a trendy new cryptocurrency, educate yourself before investing. Read books, attend seminars, consult experts, gain a solid grasp of the investment. Without understanding, you're likely to make emotional decisions and fall for scams. Knowledge is power in investments. Let's talk about trust for a second. When you hand over your money for an investment, you're essentially placing your trust in the person or team managing that investment. That's why it's absolutely critical to do your due diligence and really get to know who you're dealing with. Research their track record, talk to other investors, and look for any red flags that raise concerns. Have they been involved in any shady dealings? Do they have a history of lawsuits or financial mismanagement? These are all crucial questions you need to ask. Remember, investing is a people business. Trust your gut instincts. If something feels off or you're not comfortable with the people involved, walk away. Skin in the game, why it matters if they're invested too. Always look for investments where the promoters have skin in the game. They're putting their own money where their mouth is. This shows their belief in the project and commitment to its success. If they're asking you to invest, they should too. A substantial personal investment aligns their interests with yours. If they won't share the risk, it might be a sign to walk away. All buzz, no substance, don't fall for empty promises. Let's be real, there's no shortage of get-rich-quick schemes and hyped-up investments promising the world. But here's the catch. They're often long on promises and short on substance. You'll hear buzzwords like disruptive technology, exponential growth, and guaranteed returns. But when you dig beneath the surface, you'll find a flimsy business plan, unrealistic projections, and a whole lot of hot air. Remember, if it sounds too good to be true, it probably is. Don't get swept up in the hype. Focus on investments with a solid track record, a clear plan, and realistic expectations. Risk-free guarantees? That's a huge red flag. Let me tell you something. There's no such thing as a risk-free investment. If anyone ever guarantees you a specific return with zero risk, run for the hills. It's simply not how investing works. Every investment carries some level of risk, whether it's market volatility, economic downturns, or unforeseen circumstances. Anyone who tells you otherwise is either lying or delusional. Now, this doesn't mean you should avoid all risk. In fact, healthy risk-taking is often necessary for substantial returns. But it's about understanding and managing that risk, not pretending it doesn't exist. We've all seen it happen. A particular stock, cryptocurrency, or investment trend suddenly explodes in popularity. Everyone's talking about it, social media is buzzing, and it seems like everyone's making money except you. But here's the thing. When an investment is being hyped up by people who don't have a deep understanding of the underlying fundamentals, it's often a recipe for disaster. Remember the dot-com bubble? Countless investors got caught up in the hype, poured their life savings into overvalued tech stocks, and lost everything when the bubble burst. Don't let FOMO or fear of missing out cloud your judgment. Do your own research, consult with experts, and don't blindly follow the herd. Now, this next point is especially important for those of you just starting out on your investment journey. Never, ever borrow money to invest, especially in the early stages of building your financial foundation. It might be tempting to take out a loan or rack up credit card debt to jump into a hot investment opportunity. But here's the thing: leverage, while potentially amplifying gains, also magnifies losses. And if the investment goes south, you're left with not only the initial loss, but also the burden of debt. It's a recipe for financial disaster. Focus on investing what you can afford to lose, gradually increasing your investment capital as your income and net worth grow. Now, let's talk about the people behind the investment. A strong investment often hinges on the strength and expertise of the team managing it. Look for investments with a team that possesses unique skills, experience, and a proven track record of success. But here's the key. Ask yourself, is this team easily replaceable? Could someone else with similar skills and experience step in and achieve the same results? If the answer is yes, it might be a red flag. You want to invest in teams with a competitive edge, a unique vision, and a level of expertise that's difficult to replicate. When considering an investment, it's important to assess your level of involvement and influence. Ask yourself, can you actively contribute to the success of this investment? Do you have the skills, knowledge, or network to add value? Or are you simply a passive investor with no real say in how things are run? Now, there's nothing wrong with being a passive investor, especially if you're comfortable with the team and the investment strategy. But if you're looking for more hands-on involvement and the ability to influence the outcome, make sure the investment aligns with your strengths and allows for active participation. This one should be a no-brainer, but it's amazing how often people fall for investment scams promising outrageous returns with little to no effort. Let me be blunt. If an investment opportunity sounds too good to be true, it probably is. These scams often prey on people's desire for quick riches, using high-pressure sales tactics, fake testimonials, and unrealistic promises to lure in unsuspecting investors. Remember, there's no shortcut to wealth creation. Building true wealth takes time, patience, and a disciplined approach to investing. Now let's talk about time horizons. When it comes to investing, patience is key. Avoid investments that prioritize short-term profits over long-term stability and growth. Look for investments with a solid track record, a sustainable business model, and a long-term vision. Remember, building wealth is a marathon, not a sprint. Don't get sidetracked by short-term market fluctuations or the allure of quick gains. Stay focused on your long-term goals and let the power of compounding work its magic. Here's a crucial point that's often overlooked. Never make investment decisions in a vacuum. It's essential to consider the broader market context, economic trends, and external factors that could impact your investment. For example, investing in real estate during a housing boom might seem like a surefire win, but if interest rates suddenly spike or the economy takes a downturn, your investment could quickly lose value. Always do your homework, stay informed about market conditions, and be prepared to adjust your investment strategy accordingly. This one seems obvious, but you'd be surprised how often it's overlooked. Always get everything in writing when it comes to investments. Verbal agreements, handshake deals, and promises made over a fancy dinner, none of it holds up in court. Make sure all agreements, contracts, and investment terms are clearly documented and reviewed by a legal professional. This protects your interests, ensures transparency, and provides legal recourse if something goes wrong. Let's talk about liquidity. Liquidity is how easily you can convert an investment into cash. Publicly traded stocks are highly liquid. You can sell them quickly on the open market. Real estate or private equity are less liquid. Selling them can take time and involve costs. Assess an investment's liquidity. How quickly can you access your money for emergencies or opportunities? Aim for a diversified portfolio with liquid and illiquid assets. This helps meet short-term and long-term financial goals. So there you have it, guys. 15 telltale signs of a bad investment that you absolutely need to avoid. Remember, investing is a journey, not a get-rich-quick scheme. It requires patience, discipline, and a commitment to lifelong learning. Stay informed, do your research, and don't be afraid to seek advice from trusted financial advisors. If you found this video helpful, give it a thumbs up and share it with your friends who are also on their investment journey. And as always, thanks for watching Entrepreneurial Edge, and I'll see you in the next one.